All right, let's just dive right into it. Today, we're going to look behind the curtain and figure out how financial markets actually function. We're going to step away from the minute-by-minute charts for a bit, leave that retail gambling mindset completely at the door, and really treat this like an educational deep dive into the nuts and bolts of market mechanics. You know, if you've ever felt like the market is literally actively working against you, well, you might actually be a lot closer to the truth than you realize. So, I want to kick things off with a bit of a provocative question. Something that, honestly, most casual traders just never stop to ask themselves. When the market is totally euphoric, when it's pumping and absolutely everyone on your social media feed is screaming to buy, where is the underlying volume actually coming from? Because for every buyer, there has to be a seller. If you're entering a trade, someone somewhere has to be taking the exact opposite side of that position. And realizing who that is, well, that changes absolutely everything.
Here's our quick roadmap for today's class. We'll start with institutional order flow, move on to how liquidity is engineered, break down the accumulation, manipulation, and distribution cycle, talk about the psychology of FOMO, and finally, wrap up with how to cultivate some real, unemotional market patience.
Okay, starting off with Section 1, Institutional Order Flow Explained. This is the absolute foundation of all market movements.
Now, the absolutely crucial point here is wrapping our heads around two specific terms: smart money and liquidity. Smart money is basically the massive banks, hedge funds, and huge financial institutions that move billions of dollars around. They literally dictate the trends, but they have a huge problem: size. Smart money needs immense liquidity to enter or exit the market, otherwise they just crash the price. So what is that liquidity actually made of? Well, to put it bluntly, it's made of your stop losses. Especially in wildly volatile spaces like crypto, the stop loss, the exact thing you use to protect your trade, is the literal facility that institutions use to absorb the massive volume they need.
There's a really distinct hierarchy in market structure that we have to respect. The higher time frames, think the daily, weekly, and monthly charts, act as what we call the parent structure. That parent structure dictates the true institutional trend because, frankly, that's where the bulk of the money lives. The lower time frames, the 15-minute or 5-minute charts that everyday traders just endlessly obsess over, are strictly subordinate to that massive institutional volume. If you don't know what the parent structure is doing, you're basically flying blind.
Which brings us to Section 2, Engineering Market Liquidity. Let's look at how they actually get into these massive positions.
Like we just talked about, large institutions simply can't log into an exchange and just click buy. If they tried that, their gargantuan orders would cause the price to instantly gap up, leaving them with terrible entry points. So what's the workaround? They literally have to engineer liquidity. They purposefully manipulate the price to drive it straight into the areas where retail traders have parked their stop losses. Bam! When those stops hit, it triggers a massive flood of automatic sell orders. The institutions then swoop in and buy up all those forced sales. We call these areas liquidity pools. And hunting them, that's just a regular Tuesday for smart money.
All right, moving to Section 3, Accumulation, Manipulation, and Distribution. Let's break down the mechanics of how this actually plays out.
There's a highly repetitive 3-step cycle used to harvest this liquidity over and over again, known as the AMD cycle. It is incredibly ruthless and highly efficient. Step 1 is accumulation. This is where smart money quietly, slowly builds their position inside a tight, boring price range. No sudden movements. Step 2 is manipulation. They deliberately engineer a sudden, fake price move out of that range. This tricks the retail crowd into jumping in, and it triggers all those resting stop losses. Finally, step 3 is distribution. Once the retail traders are totally trapped going the wrong direction, the market reverses. Smart money offloads their bags at a massive profit, and retail is left holding the bill.
Think about that sharp spike up right before a massive structural drop during the manipulation phase. In institutional trading circles, this totally fake-out move is famously called the Judas swing. And it's no accident. It's deliberately engineered, very often right at the market open or exactly when high-impact news drops. It is literally a shiny piece of bait on a hook, tricking the whole retail universe into buying aggressively right before the floor falls out.
Section 4, the psychology of FOMO. Why does this trap work so well on us day after day? In the very middle of a trading range, there's usually this massive, chaotic chop. Whales, the massive institutional players, are not playing nice. They actively chop up and liquidate retail traders who are just too impatient and try to trade in this muddy middle zone. They literally sacrifice the smaller fish, hunting their stops to generate the exact momentum they need to push prices higher toward their real targets.
The core psychological driver making us fall for this is FOMO, the fear of missing out. It's kind of like missing a flight. Imagine you get to the airport late and you look out the window and watch your plane literally accelerating down the runway. Are you going to smash through the security glass, sprint out onto the tarmac and try to catch a flying 747? No way, right? That's completely insane. You just sigh, walk to the desk, and book the next flight. And yet everyday traders will see a massive vertical green candle that has already taken off, and they chase it. They hit buy at the exact moment they should just be sitting on their hands.
And honestly, it's not entirely your fault. The whole trading ecosystem, especially in crypto, is purposefully designed from the ground up to hijack your nervous system and override your logic. Exchanges use these flashing neon red and green colors to literally spike your adrenaline. Your feeds are flooded with clickbait influencers promising the next 100x pump. It's an entire industry built on artificial urgency. They want you feeling rushed, panicked, and greedy. Why? Because an emotional, panicked trader is highly predictable liquidity for the smart money.
Markets always, and I mean always, fluctuate between these two crazy extremes. Absolute market tops happen during peak greed. That's when the market is totally euphoric, wildly optimistic, and your neighbors are asking you how to buy crypto. Consequently, that is the exact moment uninformed investors are willing to pay the absolute highest possible prices. On the flip side, market bottoms are forged in peak fear. The panic is so intense that people dump their assets for pennies on the dollar. It's a huge paradox, but the absolute worst time to buy is exactly when it feels the safest and the most fun.
Let's wrap things up with Section 5, Cultivating Unemotional Market Patience. How do we actually fix this? The shift has to start right here. You absolutely must stop striving to catch every tiny little ripple in the market. Retail traders have this bad habit of talking themselves into taking a 6 out of 10 trade just because they feel like they need to be doing something. Listen, chasing a mediocre setup is mathematically a complete waste of your time and your capital. You have to train your brain to sit and wait patiently for that absolute, perfect, pristine 10 out of 10 opportunity. If you only pull the trigger on the best setups, your risk-adjusted returns would go way up and your stress levels would absolutely plummet.
This means making a mental shift from being a reactive gambler to a proactive investor. The pros don't spend their lives staring at minute-by-minute charts. They spend their time researching and building an emotionless, rock-solid objective system. You look at that higher time frame parent structure. You establish your positions based on real macro trends. And then you literally just wait. You let the market structure itself, not a sudden spike of adrenaline, tell you when it's time to exit.
There's this fantastic quote by market veteran David H. Weiss that just hits the nail on the head. He says, "When you are striving, struggling, forcing a trade, you are out of sync, out of harmony. The best trade requires no effort. If you're sweating, stressing out, and trying to force a position to work, you are almost certainly falling right into one of those engineered traps we talked about. Aligning yourself with the institutional order flow shouldn't feel like a wrestling match. It should feel effortless, like catching a giant wave that was already swelling right underneath you."
So I want to leave you with a final thought to mull over before you look at the charts again. Next time you see that massive sudden price spike, and you feel that manufactured urgency bubbling up in your chest, what are you going to do? Are you going to keep risking your hard-earned capital trying to chase the airplane down the runway? Or are you going to step back, respect the actual mechanics of the market, and patiently build a system so you can comfortably catch the next flight? Because at the end of the day, the choice between being someone else's liquidity or trading alongside the smart money is entirely up to you.